Well, the March jobs report is out in about 4 minutes' time. Economists expecting 135,000 jobs added to the economy last month, with the unemployment rate holding steady at 4.1%. Joining me now, ER Shares CEO Joel Schulman. The talk has been on the other side of this, the other side of the trade, if you will, is a buying opportunity. When you see NVIDIA, pushing down towards $100, you think to yourself, wait a minute. And to be clear, this is where we were in March of 2020. Right. And if you bought in March of 2020, you had strong returns.
I couldn't agree more. I mean, when we look at how much the market's come down, particularly some of these stocks, like Affirm was down 17% yesterday, NVIDIA brand name stocks are plummeting. This is a great buying opportunity. I couldn't agree more. We may not be able to pick the bottom, but we know a year from now things are going to be much better. And I think what's really not being noticed here is the long bond has dropped about 35 bips in the last 2 days. It's now 3.9%. At some point, particularly if we print a good number in CPI on April 10th, I think there could be a catalyst here, and we may see these movements going the other way.
Joel Schulman, I want to bring you in. Just want to let our viewers know that we're now below 1,000 on sell-offs, on the sell-off of the markets. The Dow is now down just 984 points. So I'm not saying that that's equated with the jobs report, Joel, but we are seeing a little bit of a pullback on futures as far as
every once in a while, good news means good news. And to the last point, I mean, this is a March report. What's interesting about that, I mean, it's not surprising healthcare continues to be a third or so of the job creation. What was interesting is retail was hiring quite a bit. The second biggest number is retail. And this is the market that's getting hit hardest right now in the marketplace. And so the retailers have been really hit hard, and the consumers. So we'll see what's going to happen going forward. But this is a necessary, what's going on with the tariffs and trying to bring the jobs back. And we haven't talked about the reshoring and so forth and the outsourcing. This has to happen. We can't continue another 5 years or so with most of our jobs being created in social services and government. We need jobs back here. We need to stimulate the economy. We need more investment in here. And to the earlier point, having local sourcing is going to be helpful. As we saw with COVID, there are a lot of problems with logistics. And so there will be a lot of good that comes out of this, although short term it's a little painful.
Budget talks are underway, but certainly, and we may learn today, Joel, we may hear more today from Congress as far as where they are. But, one of the things that's been pointed out that I don't think it's enough touches the corporate tax rate. I'm glad this is a part of our discussion, Joel, because right now companies are at 21%. I mean, remember, Kamala Harris wanted to take us back to 35%. That would have been a disaster. Now we're at 21%, but there's also the issue of no taxes on tips, no taxes on Social Security. The pay-fors is where it's going to be a little more difficult. But certainly, Steve makes a great point, and I agree with you, Steve, that it would be great to see. Let's message more about tax cuts and message more about deregulation, and maybe not message so much about tariffs right now.
Right. Well, there are a number of catalysts that can happen here. One, we could see stimulus occurring in a lot of ways. One through tax cuts, for consumers. One or individual investors. With corporations, having the rate come down. With stimulus for investments, which would really be nice. And then we can see catalysts coming in with CPI. We'll see certain markets, for example, in Phoenix, in San Francisco, in Austin, and in Orlando. We're seeing some of these markets, real estate markets coming down. We may see a good print on CPI April 10th. I'm looking at that as potentially being a catalyst. If we see real estate coming down, instead of going up by 0.3, 0.4 every month, maybe it comes in 0.2, 0.1. That could be a catalyst. Some of these other things can certainly be a catalyst, to the market. So a lot of bad information has been priced into the market. We've certainly seen it for the last few weeks. Some companies have dropped 30, 40%. So the market is now at a pivotal time, and catalysts can really move the positions on many stocks, quite a bit. We could see big jumps in the near future. Again, it may not be tomorrow. It's going to be very hard to pick the bottom here, right? Because there's so much negative news and people are piling on. But at some point, certainly a year from now, and that's the way investors should be looking at it, a year from now, things will be higher, and they could be a lot higher from where they are right now.
Joel, he's right that those comments coming out this week were kind of landed like a lead balloon.
Yeah, so the job to his point, jobs are being created by the entrepreneurs of this country. The big companies, they're creating the jobs, and it's the entrepreneurs, the everyday entrepreneurs, they're creating the job growth. And so to penalize them is opposite what we should be doing. We should be creating incentives for them to hire, give them incentives to invest back in. And we're going to see a reallocation issue going on in terms of people are going to a substitution effect. We're going to see, many consumers substituting, simply, American beers for Canadian beers, or California champagne for French champagne. But we're also going to see reallocation. The point was made earlier, a lot of growth in the Midwest. We're going to see sometimes, people substituting American cars for the Japanese and Japanese and European cars. So we're going to see a substitution effect going on here. One of the things I've been noticing during this segment is the long bond, the 10-year bond, is moving in an inverse manner with the market. So in other words, normally we see long bond going up, and that's good for the markets. We're actually now what we're seeing, I'm sorry, not inverse, we're seeing a direct correlation. As the long bond's going up, we're seeing the market get better. Normally it moves in the opposite direction. And so this is an interesting thing to point out, that the long bond has dropped from it's now the same level as early October at 3.9%, and that's been with the market coming down. As the long bond's going up, we're seeing the market actually picking up a little bit.